Check, please.
In this video, we'll talk about AT&T, the company itself, looking at the financials and the stock price. I know at home, if you're in love with their spokesperson, Lily, as much as I am, we'll try to keep her out of the conversation, which is difficult. But we'll show you what you should be paying for the stock moving forward. It's almost hitting our sweet spot, so stay tuned. We'll get to it. Paul, give us your take on AT&T.
All right, thanks, Seth. Guys, follow us on Instagram, Everything Money Investing. It's our new Instagram account. And then also, please don't forget to follow us personally, Seth, Mo, and I, because we have great content from just my puppies, my girlfriend, Mo's girlfriend's puppy. It's wonderful. So AT&T, guys, this is a company we've talked about a lot in the past. It was actually our first big video hit, wasn't it, Tim? 16 months ago, we had 700 subscribers on this channel, and we did an AT&T video, and we skyrocketed. So it's kind of nostalgic for us. And I think Seth's mother worked at Intel for how long, which he probably is going to say in this video anyhow. So, guys, we go to our 8 pillars software, and there'll be a lot of information later on how to get that. 8 pillars, AT&T. Okay, go down here. All right, guys. Wow, look at this. Oh, wow. It's rebounded quite a bit. It got as low as like $22 a share, I believe. Yeah, $22.02 and a high of 33, and now it's completely rebounded to $27 a share. All right, guys, so let's do our 8-pillar analysis here. So it's a $195 billion company. Pillar number 1, we want the 5-year PE to be less than 22.5. It's 13. Check mark there. And that's also with a massive drop in net income last year. They only did $1 billion of a big write-off. Pillar number 2, we want the 5-year return on invested capital greater than 9%. It is 5.2%, so that's an X. So they don't get a great return on the money invested in the business, so all the more reason to pay less money for it, okay? Now, they do have a huge dividend of $15 billion a year, it pays 7.7. And if you look, not all dividends are safe. Their 5-year average free cash flow and their last year's free cash flow is 23.44 and 25.7. So they're paying out all 2/3 of their profit of their free cash flow in dividends. So just keep that in mind going forward. I believe they actually had news on their dividend, didn't they? Wasn't there something about their dividend being cut? AT&T dividend. Let's see what they're saying here. Let's see. I don't really remember here, but I thought there was something about their dividend being cut. Maybe I'm wrong. Well, that's something to do more research on, guys, because remember, you don't want to buy something based. I've heard people buy companies based on dividend because they get sucked into the dividend trap. This one seems like they can afford it, but we're going to look at other things in the company and see if that's the best use of their money. All right, pillar number 3, we want revenue growth over the last 5 years. So 5 years ago, 160 billion, last year 173. Check mark there. Now, for a company like AT&T, go look at their acquisitions. Make sure they're not just getting revenue growth based on acquisitions. We want them to get natural, organic, same company revenue growth in the sense of if the company stopped acquiring today, would they still get revenue growth? That's what we want to see. Pillar number 4, we want net income growth the last 5 years. Now, this is a little skewed, 12.85 down to 1.1. That's an X. But look at this massive drop in net income. It immediately tells me, was there a write-off? And sure enough, other income and expenses, a minus $16 billion. So they had some sort of write-off. We want to look at their free cash flow in this case and make sure the free cash flow is stable and they made some acquisition they're writing off. Okay. Pillar number 5, we want shares outstanding staying the same or decreasing because we want the company to reward you over a long period of time for staying an investor and giving you a larger piece of the company. If a company has 10 shares outstanding and you own 1, you own 10% of the business. If they buy back 2 shares, you now own 1 of 8 shares in the company or 12.5% of the business. So your ownership went up from 10 to 12.5% by you doing nothing but keeping the shares. So we scroll at the bottom, 6.16 billion to 7.17. That's an X. But there was a big jump here. They probably made some sort of acquisition and issued shares for that acquisition. So since 2018, you have seen a little decrease overall in shares outstanding. A company of this size, this magnitude, I want them to spend their money paying down debt or buying back shares. Even more so than is more important than the dividend. But I'm sure they're going to keep the dividend because they want to keep people excited about the company and buying that massive dividend. Okay. So speaking of debt, pillar number 6, let's see how much debt they have. We go back to the main page of our software. We take the 5-year average free cash flow, 23.4. We multiply that by 5. Okay? That is $115 billion. So we want their total long-term liabilities to be under $115 billion. So let's go to the balance sheet of our software. Go all the way to the bottom. And they have $284 billion in debt versus the $115 we want them to have. That's a massive X, guys. They have a lot of debt here. They have over double the debt we want. That's 10 times. I don't like this. So to me, as an investor, a company with more debt is less likely to survive down times and bad times. So we want to make sure they have a plan for paying. This might be the reason you don't buy this company. It's because of the debt level. Okay? This is something I didn't focus on last year, but now that I look at it more and more, this debt level is really exhausting. Especially, why are they paying $15 billion a year in dividends when they have this massive debt level there? You have to go understand that debt. What are they paying per year on it? What's the interest cost, et cetera? All right. Pillars number 7 and 8 have to do with free cash flow. Now, guys, we go to the cash flow statement. Remember, free cash flow is cash from operations less capital expenditures. And you can do 5 things with that. You can pay down debt, buy back shares, make acquisitions, pay dividends, and reinvest back in yourself. Okay? We make the math easy for you. We added this line of free cash flow to our cash flow statement. It's cash from operations less than capital expenditures. We want to see pillar number 7, free cash flow growth, 15.7 to 25.7, check mark. Now, guys, remember, they only showed 1.6 or 1.2 billion in profit last year, but their free cash flow was high. Why? Because of that write down. So, check mark there. And our final metric, we take the 5-year average free cash flow of 23.4, multiply it by 20. This will give us a starting point for a market cap we want for the company in order to buy it. Now, if the company's selling for less than that, does that mean you automatically buy? No. It just means you have to do more research to decide if it's worth it. 23.4 times 20 is $468 billion. And their actual market cap was 190 or 195. It's a massive check mark. They're selling for less than half of the desired market cap. So again, does that mean you buy? No, that debt level is very high. But the final thing we're going to do. So here's the 8 pillars. First off, guys, for those of you who didn't like the math, here are the 8 pillars for you. Our software does this automatically for you. So shares outstanding increasing, net income decreasing. I'm not as worried about that because we saw the write-off and the low return on invested capital. Maybe not as, I'm actually not worried about this company, except for this. That debt level, 12 times the 5-year average free cash flow. I don't like that. That's ugly to me. Ugly, ugly, ugly. Now, we're going to use the most famous part of our software, the stock analyzer tool. All of our users who buy our software love the stock analyzer tool. Every investment is the present value of all future cash flow, right? We don't know the future. If we did, we'd all be multi-gazillionaires. We don't know the future. What we can do is we can make assumptions about the future, put them in the stock analyzer tool, and it'll tell us exactly what we should pay for the company today based on those assumptions. So let's go to stock analyzer tool. First off, years of analysis. I always pick 10 for large, stable companies. Now, revenue growth. You see right here, guys, it shows all of our 1, 5, and 10-year numbers. Your job is to make these assumptions low, middle, and high. I always tell people, be conservative here, be aggressive here, and somewhere in the middle where it's likely to occur in the middle. Okay. Low assumptions. I'm actually going to go -2, 0, and 2% revenue growth because it's such a big company. And organically, is it growing? Yes, they can make acquisitions to grow, but I don't want to focus on acquisitions for growth because companies tend to overpay for acquisitions. Profit margin. I'm going to ignore last year's abysmal profit margin. I'm going to go 8. I'm going to go 7.75, 8, and 8.25. Free cash flow margin, 12, 13, 12, 12.5, and 13. PE. I'm going to go 10, 12, and 14. Guys, it's too big of a company for me to pay some premium. I got to be cheap on it. I got to pay 10 times free cash flow and earnings. So again, right here. And the desired return. I always do 12.5. Why do I do 12.5? Well, guys, if you could invest in an ETF and get 9 or 10%, to invest in individual stock, give yourself margin of safety and give yourself a reason to do it. Or else, why do all this work? If you're only going to get a 10% return, why do the work? Put it in an ETF. Save yourself that time and hassle. So we hit the analyze button. All right, guys. So we have a low range of 14 to 20 and a high range of 22 to 35. I will say I want to be closer to this because of their debt level. I do want to be on the low end of this because of their debt level. I'm probably a buyer in the low 20s of AT&T. Even that big dividend, I know it's attractive to get 7.7%, but that debt level is just insane. It really bothers me. That's how I use Stock Analyzer tool, because it keeps in mind going, wait a second, yeah, maybe that debt level isn't. If the debt level wasn't there, first off, their earnings would be a lot higher. If they were able to pay off debt and get, I'm trying to think. They should issue a lot. No, they don't want to do that. Yeah, I just don't like the debt levels. And they're paying so much dividend. Just cut the dividend back in half, pay down debt. But even then, how much is going to pay down debt? $7 billion? I mean, they have 200. I see, this is too hard for me to understand stock because I don't get those debt levels. And I don't know if I want to do the work to get those debt levels to understand that. What's the point of the debt level? So anyhow, this is the way I look at the company. I'm not saying I'm right or wrong. I'm just saying the debt levels are too high. Because debt is just like for people, debt's for companies. If there are hard times, it's hard for them to pay the debt. That's when they run into financial issues. So that's my take on AT&T.
If we get super close on one of these stocks, you're going to need to have the software and the Stock Analyzer tool in the palm of your hands. And you can, by joining our community, get it on your phone. You'll shed so much light on making stock picks moving forward. You have a long life ahead, so you might as well be educated, and we can help Paul tell them about the software.
And the reason we created all this software is because as we made videos of the company, people would reach out to us and say, hey, how do I analyze my own companies in order to do the analysis versus waiting for you guys to make a video? So we created a software. You get everything you saw here. You get everything on the main page that's also coming soon, right here to the right side. You get 30 years of financial data. You get access to Seth Moe and I in our exclusive Everything Money chat here at the top, EM Community Chat. You get the Stock Analyzer tool. You get real estate calculator, retirement calculator. You get 8-pillar portfolios, which allows you to put up to 50 stocks in a portfolio to tell you how all 50 companies do at once, or 20 companies, doesn't matter. But exclusive daily content. We make 1 to 3 videos a day that we post. They're called A Few Good Minutes. They're wonderful. Seth Moe and I make them. But most importantly, guys, is this EM community. We have over 6,000 people that constantly talk in the community about their investment ideas, because the great thing about the internet is it allows all of us who have a certain way of thinking to come together and talk about our investment ideas. We have people in there saying, hey, I'm looking at blah, blah, blah. I'm looking at Ford stock. What do you guys think? And people have a good, engaging conversation about it. This is all available, all in our tool, all of this for about $1 per day. Sign up now. $1 per day gets you all of this. For the price of a cup of coffee, you get all of this, $1 per day. Sign up. And the best part is, whatever you sign up for today, that's your price that's locked in, because the price goes up every single month. But you're locked in at the price you sign up for today. So $1 a day gets you all of this. No-brainer, guys.
AT&T is one of my favorite stocks to day trade because it goes through such long trends. You can see back here, this thing came down through the sweet spot in June, and it just stayed down on the bottom for such a long time, multiple months, from basically August through the end of December. You will get to the point where this thing gets to the top and it goes sideways and the price continues to go higher. And if we look at AT&T right now, we are smack dab in the sweet spot. This is an awesome looking stock right now, coming through the sweet spot perfectly. You're getting engulfing candlesticks. This candlestick that you got on Friday was just absolutely perfect. So right now, we're running into our 200-day moving average. That's what's stopping us right now. I'll pull up the daily chart. But what we need, get through the 200, engulfing candlestick like this, that is your next add point. And if you want to be a long-term trader, AT&T is certainly a stock that you want to keep in your portfolio. Now, here's what you need to get through that 200-day moving average, that white line right there. You need volume, and you don't have that. So for the last 7 sessions or 6 sessions, you have not been able to get through that. As soon as we get a big chunk of green volume coming in here, a breakout over the 200, this thing is going to be off to the races, and you're going to have a really good run on this thing. Now, I love to use the example of ATT on stocks not to day trade. When you look at day trading, you want to have stocks that have a really high beta, between 2 and 4%. That gives you the volatility. If you look at what the beta is of the S&P 500 or the SPY ETF, it's 1, because that is the market. Now, everything else is compared to it. So if you look at a square, the beta is about 3. That means that as the market moves, Square is going to move 3 times the market as far as volatility goes. With AT&T, I think that the beta is like 0.6 or something. So you really don't get any movement with it. You might get a movement here day to day, maybe once a month or something like that. But overall, Ignore it. Look at this stock from a long-term perspective. This is if you're looking for stocks to go long on, this is the perfect one for you to get in on. So if you want to learn these rules, come and join me. You get access to the Trading 101 series, which is all the rules that you need to be successful. The Employed Trader series, which is 6 stocks that I update you on every single day. The exclusive Saturday seminars, 1 Saturday per month. I give an open Q&A session to just the Bid and Ask Nation, and a chat community of 1,000+ people. Come and join me.
Okay, that's our take on AT&T. We are close on this one. We will keep you updated. My mother worked for this company for 50 years, so it's near and dear to my heart. But I will follow the numbers. Paul will help us. Mo will help us with trading. And stay tuned. Follow along. Join the community. Fondle the thumbs up on the way out. And we'll see you next video. Thanks for watching this.